Hello everyone, welcome to another video on the Accounting for Managers series. In today's video, we are going to discover the 12 accounting concepts. Okay, so these concepts are very much important to us in order to understand the rules behind how we write these journal entries or how we are supposed to uh, understand or comprehend our accounting reports and other books. Okay, so let us get started. So before we go in depth into the 12 accounting concepts or the 12 accounting concepts, we will just quickly touch across the different branches of accounting and the career choices one could make when we are into the accounting field. Okay, so a few of the branches are financial accounting, where we are interested in what you can say in budgeting and the financial performance of what all money was spent or how much income we got, all those things. Management accounting is a branch of accounting which is to cater to the needs of the managers, like to give them the reports like profit and loss or the balance sheets and such things like that, so that they can help decide managerial things like whether or not to expand business or whether to cut down certain product lines, whether we can increase the budget, are we going in a good positive growth rate, or are we not doing so well. All those kind of managerial decisions, in order to take them, whatever reports and everything needs to be prepared, that comes under managerial accounting or management accounting. Another thing is cost accounting, then auditing. This accounting is done for the audit purposes, taxations, accounting information system, fiduciary accounting, and forensic accounting. So these different types of and branches and all were explained in the previous videos. So the areas of practice, like as a career choice, you could be into public accounting, where we provide advisory or audit and related services to contractual clients, or we could be as part of the commerce industry, where professionals are employed in a private company, or we could be professionals working for the government agencies or as professors or research authors. Okay, so these are a few career options we have when we are talking about accounting. Okay, and accounting that we see today emerged from what was actually stewardship accounting. So when you trace back the roots of accounting, we can see that the first form of accounting actually came from stewardship accounting. So what is stewardship accounting? I'll quickly touch on it. So the stewardship accounting is like, see, earlier we had the concept of the kings and all. They had the entire kingdom actually was belonging to them, right? Their entire kingdom, whatever land or whatever resources were there, it used to belong to the king, right? Now the king can't go and individually look at all the lands or divide it among people or collect the taxes. He can't do it individually, right? So he would break that land and give certain pieces of land uh, to the ownership of zamindars, right? Now they will give it to the peasants for cultivation and stuff like that, and they will take whatever uh, what you can say, whatever crops harvest they get, and then accordingly they will transfer it to the king, right? So they needed some books to be maintained to detail on how much was cultivated, how much we got, and based on that the taxes had to be given, all those things, right? So that is where actually the accounting first actually came into the picture. The concept of accounting, of keeping a track record of what was given and what was in return, what we got, all those things. So that concept is what is called the stewardship accounting. And from that stewardship accounting, we proceeded into financial accounting. Now financial accounting is something what you can say, it started coming into the picture when we had large scale businesses coming into picture, like during the industrial revolution and all. So what happened is that business organizations started giving out shares. Okay, so as to amass capital and all. So basically it is like, um, there was a need in the society to mobilize whatever savings were there with the people and channelize them into profitable investments. So for that purpose, accounting had to be progressed. Accounting had to progress from what was earlier just stewardship accounting, and we got to the financial accounting. Coming to cost accounting. So as we said, right, the industrial revolution happened, and um, what happened is that we started amassing capital from the people to mobilize their savings and channel it to different industries which could be utilized, right? But now what happens? Okay, so every raw material that had to be purchased, every labor that had to be brought in, or any maintenance, all these things, new machinery, everywhere cost is incurred, right? There is a cost to the company. Now naturally, in order for the business to be maximum profitable, especially when there is a large competition around, the focus is to cut costs, right? to cut cost and maximize profit. Now, how can we cut cost without knowing where all we are, where all or what all things are costing the company, right? So when that kind of an attitude or that kind of requirement came into picture, that is when cost accounting developed. And this again was definitely involving the methods and techniques for ascertaining the costs with a view of controlling them and assessing the profitability and efficiency of these enterprises. Okay, so that is cost accounting. And similarly, just like cost accounting, we wanted cost accounting so that managers could take appropriate decisions to cut costs. Management accounting is just kind of like the next step in this evolution. Okay, what this is that deals is that when cost accounting was just focused on cutting the cost, um, this management accounting was concerned with the preparation and presentation of these accounting and controlling informations in a form which could assist our management in the formulation of policies and in decision making on various matters concerned with routine or non-routine operations, like whether or not we can expand into certain areas, whether it is the right time to hire more people, should we fire people, or should we cut any different product lines, do we have the budget for a new machinery or something like that, how much dividend can we pay this year, all those kinds of things, all those decisions if managers wanted to take, then that need gave rise to the management accounting system. And this CSR accounting, or this corporate social responsibility or social responsibility accounting, that is more or like a recent development in the accounting. Okay, and that has come because of an increased social awareness, which is recently becoming more and more prominent. Okay, so what this does is actually it takes into account what all impacts could what you can say business decisions affect the economic effect, affect the society, like economic effects or all those things. Okay, so the ecology, the industrial growth, all these things, how business decisions could impact, and based on that, right now we are having social responsibility accounting also. So it is not just profit right now, but also social well-being and progress that is being considered as what you can say as benchmarks or as trademarks of a successful sustainable business model. Then again, like every company has a lot of employees, how do we provide proper information about the economic value of our human resources, like how much are we paying them and how much can we make profit out of their labor, how we can include that comes in human resource accounting. And then definitely we have inflation, our assets will change, have changes in their value, how can we accommodate those changes or that inflation into our books of accounts is what inflation accounting deals with. So that is a quick what you can say overall picture about all these emerging roles of accounting, how accounting is emerging. After a few years or after a couple of decades, again new types of accounting will definitely come into picture to cater to the needs of the then society. Okay, now let us come to the main concept or the main topic of our video, that is accounting concepts. Okay, so what are accounting concepts? They are actually you can say these few assumptions. Okay, you can say that these are assumptions on the basis of which financial statements of a business entity can be prepared. Okay, so the thing is that accounting, though we say it is a science, it is not a pure science, as in there is no fixed rule as is. Uh, Different people can think of what you can say, if left unchecked, different people will have different interpretations of different financial transactions, and I will get to that in another video. Okay, where we see how we have to what you can say write down the debit and credit entries, how we can read and understand the transactions and all. So this concept of why we need a general consensus of on how one particular transaction has to be universally read and understood, why it is important, I'll get to it in that video. Okay, but for now just understand this. Okay, if every other person would have a different understanding of how a financial transaction has to be understood on. Okay, how we should understand its impact in our business. So if everybody goes about writing down in the books of accounts according to them, we cannot compare, right? There is no common ground to compare, so it becomes very difficult, and it will when you think of it in a global scale, it will defeat the purpose of why actually we even went for accounting. So that is why accounting concepts or these assumptions have come up only because of a certain number of people who were in the positions responsible, they came together, they sat down, and they came to a common consensus about how we should treat certain transactions. Okay, so these accounting concepts, when we follow, what happens is that we it can help in saving the time, effort, and energy of accountants, as the framework is already said. So it goes like the same way, like this is an apple, and we all call this apple in English, right? Or this is a mango, we all call it a mango, right? Sorry for my terrible drawing, but you get the idea, right? Now if I call it apple, I call this apple, and you call this mango, but I call this mango, then it creates a whole lot of confusion, right? It will become madness. We don't need that. And if this happens, then we'll have to do a lot of translations, a lot of errors, but it becomes very simple when I also call this apple and you also call this apple. When we are conversing, it is clear that if we use the term apple, it is this apple, right? Or this is mango. So that is exactly the same reason why we have these accounting concepts, and why we are all uh, what you can say, why we are all supposed to stick to these accounting concepts. Okay, so as naturally what we can conclude is that with these help of these accounting concepts, the quality of our financial statements and reports will be improved, because there will be much more better understandability, reliability, relevance, and comparability of such financial statements and reports. So when we come to accounting concepts, we also have to know about accounting standards. Okay, so accounting standards are the, we said, right, accounting concepts are a set of assumptions. So these standards are a set of rules, guidelines, and principles that are framed by regulatory bodies or the government, that acts as a framework for these accounting policies and practices. In US, we have the GAAP, that is generally accepted accounting principle. Okay, so in US, when, or the countries that is following this GAAP, they will prepare the financial statements according to this standard. In India, it is Indian Accounting Standards, or IND-AS, IND-AS, which is based on the IFRS standards. IFRS standards are generally used in the European region. Most probably it should have happened because we were under the colonial rule of British. So anyways, we are following, we have derived our standards from IFRS, and it is called IND-AS, okay, Indian Accounting Standards. So that, apart from very minor differences in between GAAP and IND-AS or IFRS, they are mostly almost the same. Okay, we have a very minute difference actually in IFRS and GAAP, but we don't have to be concerned much about those differences right now as MBA graduates. Okay, so just as we said, like all countries can have their own accounting standards, which are framed by the regulatory bodies of those governments, and therefore country to country there could be very slight differences as well. So again, there is no universal rule as of now. Universal standard is right now not present, but maybe it might come up in the future. We don't know. Okay, so what are these 12 concepts? The first concept what we are going to learn is the business entity concept. Okay, so in business entity concept, it states that transactions that are associated with a business must be separately recorded from those of its owners or other businesses. That is, a business should be treated as a separate entity. In short, business is supposed to be treated as a separate entity. Just because I have started the business, uh, it doesn't mean that whatever I do is what the business does, or whatever the business does is what I do. I am a person, and the business is an other person, like that. Just like how the gods and all are given social entity status, right, in India, or just like how Instagram asks us to separate our personal account and our business account differently. You can think of, you can use any of those examples to uh, what you can say, etch this idea into your minds. Okay, business is treated as a separate entity. Now, I'm really sorry, since there are 12 concepts to cover, this video might get a little bit lengthy. Okay, so the reading part of it, like I've written down as much as possible in order to explain each of these concepts. I'll quickly explain to you the idea behind these concepts, but if you want to have an in-depth reading, pause the video and go through the text, okay? The next is money measurement concept. So in that, what it states is that businesses should only record accounting transactions that have happened in terms of money. So if I cannot write down a transaction in terms of money, or if the transaction did not involve physical money or cash exchange, money exchanging, then we should not be considering them in our accounting. The continuity concept or the going concern concept states that uh, the business entity we are assuming will go on for quite some time. It is not that it is like we started a business and immediately after a month we are going to shut it down. No, when we start a business we are considering it as a going concern. Okay, it will keep on existing unless there is some critical event that happens in the future, because of which it has to be liquidated or forced to discontinue for any reason. Just like a baby is born, we expect that baby to at least reach the age of 75 or 85 or even 90, unless that person comes to premature death, right? Same way, I know it is a little bit harsh example, right? But I hope you understand the concept. The same thing that we think about as a business also. It is like we are thinking of the business as a different individual, okay? If that helps. Okay, cost concept is actually stating that all these assets that are held by a business should be recorded in the books of account at prices which where they were bought. Like for example, you might have bought a piece of land, okay, maybe 1 acre of land, and at that time you bought it for 40 lakhs, say, okay, maybe you did that in the year 2000. Right now it is 2022. That asset might right now fetch you at least 1 crore, but in the books of account you will mention it as 40 lakhs only. This asset cost me 40 lakhs only, we will not mention 1 crore. Okay, so that is the cost concept. Okay, so the same cost concept we will also apply for any transportation or installation or acquisition, whatever happened, we will apply this cost concept only. Then we have accrual concept. So that is that suppose say we have sold some good for credit and we are going to get the complete payment in maybe like in a matter of 12 months or so in installments, and maybe that entire thing, okay, that maybe it is a laptop and that cost is 50,000 rupees, and it was sold on the 1st of January, let's say. Okay, so on the 1st of January we will write that entry down as 50,000 rupees we got itself. Okay, we will not write it as 50,000 divided by 12, and we will not keep on writing that on every 1st of February or 1st of March, like that we will not write. 1st of January we sold something for 50,000 rupees. That is how we will write it, and that is the accrual concept. Okay, so I will uh, please pause the video if you want to read this entire thing. Okay, we are moving to the next concept, that is conservation concept. Conservatism concept is something like what you can say, a very traditional or a very reserved approach. Okay, that is supposing we did a transaction and that transaction resulted in a liability for us. Okay, maybe we took a bank loan. Okay, so such a case, these liabilities should be recorded, okay, uh, in the what you can say in the maximum of expense. Like suppose I took a loan of 1 lakh, okay, and the maximum amount I might be having to pay back is maybe, let's say, 1 lakh 50,000, or at least I will have to pay 1 lakh 25,000. Means in conservation concept I will record that liability as 1 lakh 50,000. Okay, similarly, if I did a transaction and that transaction resulted in creation of an asset, okay, and that asset is worth let's say 2 lakh rupees right now, and that asset could if it is like in its peak good time, maybe it is like a stock, you bought a share like that, then that share is expected to like maybe grow up to around 4 lakhs. Okay, then according to conservation concept you will only record it as 2 lakhs, you will not record it as 4 lakhs. So because the minimum assured revenue we can get from it is 2 lakhs, and the maximum liability that you might have for this particular loan is 1 lakh 50,000, like that. So this way of writing down in the books of accounts is called conservation concept. Then we have another concept, that is materiality concept, and that is actually what you can say, how it's like what you can say, the concept is that all material items should be reported properly in financial statements. That is like if a transaction causes significant impact in the financial standing or business decisions, then we should definitely write it. But if it is of very small consequence, then it is okay to ignore it. Like for example, you bought two things. Okay, let us say you bought two things. One was a piece of land worth 1 crore. The other was a piece of paper, let's say piece of paper that is worth 5 rupees. Okay, so this land which is worth 1 crore definitely has to be written down in your books of account. But this paper which costs only 5 rupees, whether you write it or not, definitely it will help you match penny to penny, but it will not give a big impact in your overall business standing, right, or business decisions. It's not going to matter whether you bought one paper or you bought 10 papers, right, because the cost is very marginal compared to our business capital or compared to our turnovers and the that thing, right? So that is what this materiality concept is actually talking about. The next concept is consistency concept. So it states that all the businesses, when they are writing down their books of accounts, okay, then they should maintain the same accounting methods or principle throughout the accounting periods. That is, last year you used one concept for accounting, or last year you used certain accounting principles to create your books of accounts. Like maybe last year you followed GAAP, then this year also you should follow GAAP. Okay, this year also you should follow GAAP. Next year also you should follow GAAP. Like all throughout your accounting periods, you should be using the same principles. Suddenly, all of a sudden, you should not change your accounting principles. Why? Because then you will not be able to compare period to period. Like last year's report, you will not be able to properly compare with this year's report. Why? Because the principles have changed, right? So it will not give a comparable or true picture. It will be like kind of like comparing an apple to a mango, rather than red apple to a green apple is much better comparison. But you cannot compare an apple to a mango and say apple is not good or mango is not good, right? Same way. So that is consistency concept. The next is periodicity concept, and that states that an organization can report its financial statements within certain selected periods of time. So usually we generally in all throughout India especially, we consider 1st April to 31st March as our period, accounting period, right? So similarly, so that is what this periodicity concept talks about. Okay, so if we are following from 1st April to 31st March this year, next year also I should consider my accounting period as from 1st April to 31st March only. Suddenly I cannot change it to 1st January to 31st December. Again, what happens is that the comparability and all the balancing, everything will go berserk, because there will be duplication of transactions. The figures will get what you can say blown up or blown down. All those things could happen, right? Next is matching concept. So in matching concept, it says that all the expenses that are matched with the revenue of that period should only be taken into consideration. And in the financial statements of the organization, if any revenue is recognized, then the expense related to that earning should also be recognized. Like for example, if I am writing down, if suppose say this is a, suppose say let us say we are taking into account Lays, okay, Lays factories accounting books. Suppose I acquired a land. Okay, I acquired a land of 1 crore and I've started potato farming over there, and from the harvest over there I created Lays chips and I have sold it for 1 crore. So if I have to mention this 1 crore revenue from this land in my accounting book, then I should also be writing down what cost I had to give to acquire this piece of land and plant and harvest these many potatoes, right? That should also be written. So every revenue should also what you can say have its countering, not countering, associated expense also has to be mentioned. You cannot say that you got 1 crore revenue without saying that you had to put in maybe 75 lakhs into acquiring the land and harvesting it. That we should not omit this, because if you mark this and this, then it means that in total you got only 25 lakhs profit. But if you omit this, then it would mean that you got a profit of 1 crore. That is wrong, right? It is that is a fraud. That is if we do that. Okay, that is matching concept. Next is realization concept. So it states that revenue can only be recognized after it has been earned. Okay, so that is so in the same example of Lays, if only I sold all the packets, Lays packets I created out of these potato chips and actually got 1 crore revenue, then only I should write it down in my books of accounts. Simply by producing these chips packets and not selling them, I cannot write it down. If I sold each of those packets, then I would get 1 crore. But if I only sold half of it, means I will only get half crore, right? Then only that half crore has to be written. Until and unless I sold the rest of the Lays packets, only then I can write down the remaining revenue that I got. Otherwise, I cannot write, right? If you're feeling confused, just rewind and listen again, okay, or read through these written materials. I'm sure you will understand it. It's not actually a very difficult concept or anything. It's just that we are new to this, okay. Actually these things are quite understandable only when we think about it. It is something which we all know because if we use it in our daily lives. We have come across it in our daily lives and within our society and all, okay. It's just that we didn't know this is what it is called, and we didn't have all of these in the same place. That's it, okay. It is not something very difficult and all. Don't think of it that way. It is easy only, but it takes a little time to understand. So go through everything. If you need these notes, let me know. I'll post it in our Telegram channel, okay. Just leave a comment below the video. If anybody needs these notes, I will post it in our Telegram channel, okay. This PPT I will post it. Okay, so the last accounting or the 12th accounting concept is the dual aspect concept. So in that it says that every transaction will have a dual effect. That is, we have to record every transaction in the form of a double entry system. Every credit will have a debit and every debit will have a corresponding credit. That is what dual aspect concept says. That is, suppose I buy something, okay, suppose I buy a packet of lace from a shop, okay. Again, very sorry about my terrible drawing skills. Suppose I buy a packet of lace worth 10 rupees. Okay, 10 rupees goes from me. Okay, this is me and this is the shop. 10 rupees goes from me, but 10 rupees is gained over here by the shopkeeper, right? So every minus has a plus and every plus has a minus. That is what dual aspect concept talks about. Okay, so those were the 12 accounting principles. I hope this video helped you in understanding the accounting principles and the accounting standards, how why it is important, and the emerging role of accounting, all those things, right? Any questions, any doubts, feel free to post it in the comment section. If you want this PPT, I will post it in the Telegram channel if you leave a comment down below, okay. So all the best, study well, exams are nearing. I will try to cover as much concepts as possible before your exams. All the best, do well, bye.